Welcome back, traders and investors. We have a special guest on today. Special guest on the show today, Peter Schiff. He is CEO and Chief Global Strategist at Euro Pacific Capital. Peter, how you doing today?
Hey, I'm doing great. How are you guys doing?
Good. I mean, we got a great day to have you on. A lot of action in the markets yesterday, but just real quick, just for your economic school of thought, you like to follow the Austrian school of economic thought, and could you just tell us why you follow that?
Well, because it's right. I mean, Austrian economics is the only legitimate economic school of thought, as far as I'm concerned. I think Keynesianism, and to a lesser extent monetarism, is wrong, or supply side, or whatever other theory that you want to adhere to. I think Austrian economics is true economics, in the spirit of Adam Smith, who of course was the founder of economics. And if you look back at adherence to Austrian economics, go all the way back to the period preceding the Great Depression, and if you look at all of the major economic contractions, it's the Austrians who have seen them coming and who have offered viable explanations for how government monetary policy in particular created these problems, up to, of course, the most recent 2008 financial crisis, where it was the Austrians who were warning about it and saw it coming, and everybody else that was taken by complete surprise.
Peter, obviously the Fed has continued to print money in support of this economy here. How long can they continue to do this for? Because obviously the hole they're digging just keeps getting digger.
Well, they can continue to do it, until the next crisis, right? And of course, they're not really supporting the economy or a real economy. They're supporting the bubbles. They're providing air for financial bubbles in stocks and real estate. They're supporting the growth of government. They're supporting excess profits on Wall Street, but they're actually stifling the legitimate economic growth that might otherwise help Main Street. So if you look at the nature of this phony recovery, if you own a lot of stocks, you're better off, right? But if you're working for a living, you're far worse off, because the chances are your wages have not kept pace with the increase in cost of basic necessities like food and energy. And in fact, in many cases, you lost your full-time job, and either you have no job at all, or you're working a part-time job, or maybe two, but you don't have the purchasing power you used to have. It's because all this money printing and the quantitative easing that is goosing the stock markets and propping up government spending is actually suppressing the legitimate economic growth that would take place if the Fed wasn't doing anything.
So you think the Fed should just stop with the easing and stop with the quantitative altogether?
Oh, absolutely. And unfortunately, though, when you stop, there's going to be a lot of damage. It's just like if you're doing a bunch of drugs, you're a drug addict, and then you stop taking drugs, there's some short-term consequences. You go to rehab. It's, you have to detox. So, it's not going to be a painless situation when we give up these government narcotics, these federal, monetary heroin. But it's going to happen, because the more we take this drug, the more damage is being done to the economy. And the risk, of course, is that eventually we overdose on it, which, is a destruction of the currency and runaway inflation, which will be the end result of this policy unless it is aborted. But of course, the longer we wait, the more painful it's going to be. And we've already waited a long, long time. So there's going to be a lot of short-term pain, which is one of the reasons that there's so much opposition at the Fed to actually doing the right thing.
Okay, Peter, you did a great job in predicting the upcoming, or the housing crisis that we had back in 2008 and 2009. What factors were you looking at, or what did you see in the economy? What did you see in the housing market that enabled you to make that prediction?
Well, I just saw what should have been obvious to everybody else who was oblivious to it, because they had too much suds in their eyes from being part of the bubble that they couldn't see it for what it was. But, I saw the Federal Reserve bring interest rates down to 1% and leave them there. And I saw the measured pace, the ridiculously slow pace with which they eventually began to raise interest rates after a couple of years. And I saw what was going on in the mortgage markets as a result of all this cheap money. I saw all the people taking advantage of the Fed's largesse by using interest only or short-term variable mortgages to buy properties. So they were taking advantage of the fact that they could borrow so cheaply in the short run. They were using it to bid up real estate prices, and I saw how this phony real estate wealth was impacting savings and consumption, how we were building an entire economy based on this phony wealth. And I also knew that one day interest rates would rise, and when they did, the real estate bubble would burst, and all the home equity would evaporate, and all these people who thought they were spending actual money would find out that they spent themselves into enormous debt. I knew that eventually the homeowners who were underwater on their mortgages would mail their keys into the banks rather than their mortgage payments. And so I knew that the banking sector would collapse because all the collateral for their loans was going to go away. And I knew that the government was guaranteeing all of these mortgages through Fannie Mae and Freddie Mac. I knew they hardly had any capital behind trillions of dollars worth of guarantees. So I knew those entities would go bankrupt. And I knew we'd have a financial crisis and the worst recession since the Great Depression. All of this was painfully obvious to anybody who thought about it. But you had all these academics at the Federal Reserve who had all this information at their disposal. All I could do is intuitively, see it, yet they had all this information. They had all these employees, all these statisticians and economists crunching numbers and working on computer models, and they couldn't see what was ridiculously obvious. And that's how inept they are. And it's the same people who were that inept in the past that are leading us today, and who are proclaiming victory, and that their policies have worked, and that we have this great prosperity ahead of us, when they can't see an even greater financial crisis looming on the horizon than the one that they already missed.
Yeah, and we obviously had the housing bubble, we've had the financial crisis already, and now we appear to have another bubble forming here again. How do you position yourself? Because we know, like, you could have said this, I guess, back when we were at S&P 1500 or 1600. We keep going up here. How do you play this, safely, play this market safely for when
it's not like the bubble is forming. I mean, in many cases, it's already formed. I think in housing, I don't think there's much upside left in the housing market already. And the difference between the current housing bubble and the one that already popped is that this one is basically characterized by Wall Street and speculators. You don't have average homeowners participating like they did last time. This is a private equity hedge fund market. They have come on and they have bid up all these houses. They've overpaid. They've paid cash. They're not using mortgage financing. They're hoping to rent them out and flip them, but I think they've overpaid dramatically and overestimated the ability of the people who can no longer afford to buy homes to rent them, because I don't think that they're going to be able to get enough rental income based on what they paid for these properties, particularly when their cost of carry goes up, because even though a lot of these hedge funds paid cash for their property, they borrowed that cash. You don't need to borrow through the mortgage market. You can borrow through other means and then use that cash to buy houses. So that just because you pay cash doesn't mean you don't have debt. And a lot of these hedge funds do have debt behind these properties. But even the ones that aren't levered up are still going to find that they overpaid, and ultimately they're going to look to dump these properties back on the market. The problem is there are no buyers. So I think the real estate echo bubble has already peaked. Who knows where the top is in the current stock market bubble, but it certainly is a bubble. And my guess would be, if the Fed were to follow through with its commitment to take away quantitative easing, that the bubble will pop. I don't know that 0% interest rates on their own is enough to sustain it. However, one thing that has been noticed is, even as the Fed has been tapering its monthly purchases of treasuries, foreign central banks have been growing their purchases at a faster pace than the Fed's been tapering. So, in fact, the U.S. government has been able to get the support of all the money printing. It's just coming from China and other emerging markets and Europe. And so the Fed is getting other central banks to do its dirty work. And so we're still getting this monetary support, except we've conned other central banks into doing the heavy lifting. So the question is, how much longer will foreign central banks aid in the monetization of U.S. government debt and propping up our stock market?
We get a question coming out of the chat here. Janet Yellen was testifying in front of Congress earlier in the week, and she was talking capital markets and valuations during her testimony. And is the high yield the biggest bubble in the capital markets, in your opinion?
Well, it's hard to know which one is the biggest bubble. I mean, I think the biggest bubble is actually in the U.S. dollar, even more so than in the U.S. Treasury market. But pretty much anything that has a yield is overpriced. Because interest rates are so low and investors have to stretch to get any kind of return on their savings, junk bond yields are at historical lows. And so clearly it's a bubble, especially when you take into consideration the default risk associated with a lot of these junk bonds. Because when interest rates eventually rise and we go into a severe recession, right, not only are bond prices going to fall for junk bonds because rates are rising, but in a higher interest rate environment and a recession, many of these companies will in fact fail, and therefore the bondholders will lose 100% of their principal. And right now, they're not getting compensated nearly enough for the enormous risks that they're taking, especially if interest rates are allowed to rise, which is one of the reasons that the Fed is going to be under so much pressure not to increase interest rates, even as rising inflation makes higher interest rates a necessity. I think Janet Yellen and her cohorts at the Fed will tolerate any elevated level of inflation. They'll say it's noise, they'll say it's temporary, they'll even say that it's good for us. But the only thing they won't do is try to put a stop to it, which means, in the bond market, inflation is actually your worst enemy. So if the Fed tries to save the bond market by creating a lot of inflation, you end up destroying the bondholders. The Fed is not your friend if you're a bondholder and they're printing money, because they're destroying the value of the currency that your bonds are denominated in.
So, Peter, how are you playing it then? Like, eventually this bubble is going to burst. How do you position your portfolio to take advantage of this?
Well, I mean, one thing is obviously you don't own, U.S. dollar-denominated bonds, because either you're going to lose by default or you're going to lose through inflation. So you don't want to do that. I think between stocks and bonds, if you're investing in the U.S., I'd be a stock investor, although I'd be very selective. I think, multinationals, exporters, resource companies, energy companies, those are the types of companies that if you're going to buy U.S. stocks, those are the ones that you want to own. But I think if you want to, get the best bang for your buck or get out of the buck, the most efficient way is international equities, foreign equities that are driving their earnings outside the United States, and they're paying their dividends in, New Zealand dollars or Singapore dollars or Swiss francs or Norwegian kroner. There's a handful of currencies out there that I think are going to hold their value as the dollar collapses, and I think you want to invest there. And I also try to invest in countries that have more free market economics, that are freer, that have less, fewer regulations, lower taxes, better trade balances than the United States, which of course is not that hard to find because we're a disaster. But I invest in the best countries in the world where assets are likely to gain the most value relative to assets in countries like the United States that are making so many monetary and fiscal mistakes. And then, of course, you want to buy commodities, you want to buy gold, silver, also equities. Gold mining stocks, I think, are among the most undervalued equities anywhere in the world. I mean, you're talking about a stock market bubble in like social media stocks or biotech stocks. You've got the inverse of a bubble in gold mining stocks. As overvalued as some segments of the market are, that's how undervalued the gold stocks are. So it's kind of like a bubble in reverse. People are unrealistically pessimistic on gold stocks, just like they're unrealistically optimistic on other types of stocks. So that's a great opportunity for investors who can handle the risk to really make a significant amount of money as Wall Street eventually re-rates these mining companies to reflect reality, not their ridiculous fantasy.
A couple questions here. Well, my first question is so are you holding any percentage of your portfolio in U.S. stocks?
Yeah, I mean, I have some. I mean,
Okay.
It's a relatively small percentage in publicly traded U.S. stocks. Most of my personal wealth that's in the United States other than some real estate that I own, but most of it is in energy, is in direct ownership interest of oil wells. But I also own publicly traded oil companies in the United States, oil service companies. That's kind of really my exposure to the U.S. is in the energy sector. And I've been a big investor in energy for years. But just about all my other equity exposure is outside the United States. And I would just rather invest abroad, given the fundamentals, and the valuations are much better. When I go looking for stocks to buy, when my analysts are searching for stocks, the best values, the lowest PEs, the highest dividend yields are to be found outside the United States. That's why if you look at the mutual funds that we manage, the accounts that we manage on behalf of our clients at Euro Pacific Capital, they are almost predominantly non-U.S. Equity products. And certainly for my clients who want to invest in fixed income, if they want a preferred, if they want bonds, there's no way I'm going to do that in U.S. dollars because I have no confidence in the future purchasing power of the dollar. So if you want to clip coupons on bonds, you can't have obligations of the U.S. government or any entity in U.S. dollars. So you've got to go outside the United States for those sources of income.
Which countries are you going to specifically there, Peter?
Well, I said we're certainly way overweight Asia. Not only the developed markets like Singapore and Hong Kong, but also mainland China and countries in Southeast Asia. We're investing pretty heavily. We have a lot of exposure up in Scandinavia, a lot of resources up there, and the pendulum is moving in the right direction away from massive government, which has characterized Sweden and Norway, to more free market approaches, and they're seeing big benefits from that transformation. A lot of money in New Zealand, Australia. New Zealand in particular has been one of our favorite markets, but Australia as well. We do have money in North America, mainly in Canada and Mexico, rather than the United States. And South America as well, Chile, Peru are some of the countries that we invest in. We're in Eastern Europe. I mean, we've got money we have money in Poland. There's some significant progress being made over there. So anywhere in the world that I really see the policies of big government and Keynesianism being rejected and more free market policies being embraced, where governments are getting smaller, where regulations are being repealed, where taxes are being lowered, right? Government spending is being cut. Those are the countries that I want to invest in. Now, of course, most countries are not doing that, so most countries are excluded from the ones that we invest in. And of course, once we decide what country we want to invest in and what currency, then we have to pick the individual stocks. And we have analysts that look over the stocks in the countries we like to try to find the best way to play those markets.
But so you're more comfortable with the political structure in China and some of these other countries than the United States. And then just to follow up on that, aren't a lot of these countries dependent on the United States for a lot of their trade?
Well, a lot of people think that those countries depend on the United States, but it's actually the other way around. I mean, what do they need America for? I mean, the only thing they need America for, theoretically, is to buy their stuff. But we don't have any money to buy their stuff. They have to lend us the money. So what do they need us for? The Chinese have more consumers than we do. If they have a bunch of factories that are producing products, the Chinese can consume those products. They don't need consumers in China. They got more than they need. So the Chinese provide us with actual products, and we give them treasuries. I mean, what do they have to show for those treasuries? Nothing. But we get all these products that we can consume and enjoy that make our lives better. So what if America and China stopped trading? The Chinese would get to keep all of their stuff, right? All the products that are on the shelves in Walmart, they would stay in China, and they would be on some shelves of some Chinese retailer where the Chinese people could buy them. And what would America have? We'd have empty shelves and a pile of worthless treasuries, right? That's it. We'd have paper money, and they'd have actual stuff. So we need them. They need us like a hole in the head. The question is, when are they going to figure it out? And it's not just China that's doing this. The entire world has been propping up the U.S. economy by providing us with the stuff that we can't produce. And in exchange for what? Nothing. Pieces of paper that they can't do anything with. They just keep stockpiling them. I just read that outside of China, there's about 8 emerging markets that now have 3 trillion treasuries. 3 trillion that they're just holding on to. And these are relatively poor people. What do they need with 3 trillion in treasuries? And they can't do anything with them. You know what foreigners do with their treasuries? When they mature, they buy more treasuries. And you know what they do with the interest that they earn on their treasuries? They buy more treasuries. They can't do anything with them. They can't spend any of the money on anything they actually want. Because if they actually tried to spend the money, the dollar would collapse and they couldn't buy anything because we don't make anything. That's the problem.
Okay, we definitely we just got your feelings on that one. Okay, Peter, great advice and wisdom here for our investors and traders. Just to close things out, you had mentioned, gold mining stocks, for investors. And, we're talking about people, that have a discretionary part of their portfolio. Besides the gold mining stocks and, maybe the physical gold, do you have any, in the energy sector, you mentioned that, do you have any other stocks or sectors you would recommend? And then
natural resources in general, agriculture. Look, people can go to my website, europec.net, talk to brokers at Euro Pacific Capital about the specific stocks that I like. I never really get into them on a radio show, but we can, give out recommendations to prospects and customers. We can manage your money if you'd like in separately managed accounts or through my 9 mutual funds in the Euro Pacific Capital fund family. And, I'm going to be doing my own radio show, too. An hour from now, I do the Peter Schiff Show. The show is from 10 a.m. to noon Eastern time, Monday through Friday. So if people want to tune in, and they can even call in, I take calls. Again, you go to schiffradio.com, just my last name, SCHIFF radio.com, to listen to the show. And it's live at 10 a.m., but you can go there anytime you want and listen to the repeat broadcast.
Wow, that sounds like some great listening for our viewers. And just finally, I mean, you've given us your opinion and just final advice for investors, whether big or small. What would, if you had your closing statement?
Well, do your homework, tune out the noise. Don't listen to the so-called experts, the talking heads on the popular financial channels or even in the publications. They really don't know what they're talking about. So you've got to search out the information on your own. You can't follow the crowd. You've got to lead the crowd. You can't, invest in what's hot, but you've got to figure out what's going to be hot, but invest in it while it's still cold, right? It's, if you want to buy low and sell high, you can't do that if you're buying what everybody else is convinced is going to keep going up because it's already priced in. You got to find the assets that other people don't value and figure out what the catalyst might be to change that situation, and then buy ahead of the curve, ahead of the crowd.
Okay, Peter Schiff, CEO and Chief Global Strategist at Euro Pacific Capital, giving us his take on the markets. Peter, thanks a lot for taking your time out from your busy day to be on, and we hope to speak to you again.
Hey, anytime. Thanks a lot, guys.
Okay.
Thanks, Peter.